Why every country is in debt and who they owe now is a story rooted in how modern economies function rather than a tale of simple mismanagement or corruption. At its core, government debt exists because nations borrow to fund public spending that cannot be fully covered by taxes alone. This includes building infrastructure, supporting healthcare systems, maintaining education, paying pensions, stabilizing the economy during downturns, and responding to emergencies like wars, natural disasters, and financial crises. Debt is not automatically negative. It is a tool. The problem emerges when it grows faster than economic growth, or when borrowing is used to delay necessary reforms. Countries borrow money by issuing bonds, taking loans from domestic and foreign institutions, and occasionally borrowing from international bodies such as the IMF or World Bank. The creditors vary, but they typically include domestic investors, international financial institutions, foreign governments, pension funds, insurance companies, banks, and individual investors. The largest share of public debt for most developed countries is actually owed to their own citizens and institutions, not foreign powers. For example, most of the United States debt is held domestically by pension funds, banks, mutual funds, and the Federal Reserve. Only a smaller fraction is held by foreign countries such as Japan and China. Similarly, Japan owes the overwhelming majority of its debt to Japanese citizens and institutions. This distinction is important because owing money to domestic savers is fundamentally different from owing money to external creditors. The interest stays within the national economy rather than being paid abroad. Countries often enter debt not because they failed, but because borrowing allows them to manage the business cycle. During recessions, governments may increase spending or reduce taxes to prevent economic collapse. This approach is based on widely accepted economic theory that investing in people and infrastructure during difficult times can support long-term growth. After the 2008 global financial crisis, and again during the COVID-19 pandemic, nearly every country increased debt to keep households and businesses afloat. Without such interventions, unemployment and poverty would have risen sharply. Many modern economies are designed around an expectation that governments will borrow since balanced budgets every year are difficult to achieve without harming public services. In developing countries, borrowing also finances essential physical and social infrastructure: roads, bridges, electricity grids, schools, and hospitals. Without credit, many poorer countries would struggle to grow. However, these nations face more risk because they often borrow in foreign currencies, usually US dollars. If their own currency loses value, repaying becomes much harder. This dynamic explains why some lower-income countries have faced debt crises when global interest rates rise or when commodity prices fall. A country that must repay dollar-denominated debt at the same time its currency weakens may suddenly owe far more in real terms, even if it did nothing wrong. When asking who countries owe now, the answer depends on the nation, but several major categories are consistent worldwide. The largest category is usually domestic investors. These include pension funds, mutual funds, insurance firms, and households that buy government bonds. Another significant creditor is the central bank. Many central banks purchase government bonds to stabilize financial markets or manage interest rates. International investors, such as foreign banks and funds, also hold government debt, but less than people often assume. Some debt is owed to multilateral institutions like the IMF, World Bank, and regional development banks. These loans are typically used during crises or for long-term development projects. Foreign governments can also be creditors. For instance, China lends to developing countries through various infrastructure programs, and Japan has long been a major lender in Asia. However, claims that any single country owns others through debt are often exaggerated. Debt relationships are complex, widely distributed, and managed by market systems. For most major economies, domestic creditors remain the largest holders. The question of why every country seems to be in debt today is tied to how financial systems evolved. Debt is a central component of modern capitalism. It allows governments to spend now and pay later, smoothing economic performance over time. The alternative would be abrupt tax changes or severe cuts to public services. Because populations expect stable pensions, functioning healthcare, affordable education, and stable currencies, governments rely on borrowing to ensure continuity. Another factor is demographic pressure. As people live longer and birth rates fall, governments must support growing numbers of retirees. Taxes often cannot fully cover these costs, and borrowing fills the gap. Military spending also contributes, especially in countries involved in conflicts or large defense programs. While this spending may be justified for national security, it still adds to public debt. In some regions, the legacy of past crises continues to shape debt levels. Countries like Argentina, Greece, and Lebanon faced major economic collapses that forced them to borrow heavily and sometimes restructure their obligations. Others, such as Germany and the United States, accumulated large debts during global conflicts and major recessions. Economic shocks tend to leave lasting financial scars. A related issue is global interest rates. When rates are low, borrowing is cheap, and governments may accumulate more debt because repayment costs are manageable. Between 2008 and 2021, many countries issued large amounts of debt at extremely low or zero interest rates. When inflation resurfaced and central banks raised rates, the cost of servicing that debt increased sharply, putting pressure on public finances. Some governments now must choose between higher taxes, reduced services, or more borrowing. The sustainability of debt depends on several factors: economic growth, interest rates, inflation, government credibility, and currency stability. A wealthy, stable country with strong institutions can carry a high level of debt safely, while a poorer, less stable nation may struggle even with moderate borrowing. Japan is a clear example. Its debt-to-GDP ratio is among the highest in the world, yet it remains stable because most of the debt is domestic, interest rates are low, and investors trust the government. There are also misconceptions. If a country prints its own currency, such as the United States, Japan, or the United Kingdom, it cannot technically run out of money in the same way households do. It can always create currency to pay back bonds denominated in its own currency. The downside is inflation risk if done excessively. In contrast, countries that borrow heavily in foreign currency cannot print their way out of obligations, making them more vulnerable. This is why defaults and restructurings are more common in developing economies. When sovereign debt becomes unsustainable, countries may negotiate with creditors to extend maturities, reduce principal, or lower interest rates. Argentina, for example, has restructured multiple times. These are painful events and often come with economic and political consequences. Ultimately, debt exists because modern societies decided that stability, growth, and public welfare require financial flexibility. The key question is not whether a country has debt, but whether that debt is sustainable and used productively. Debt can fund useful investment, schools, railways, renewable energy, medical research, or it can finance short-term consumption without building long-term value. Some countries struggle because borrowed money was misallocated or because corruption distorted spending. Others thrive because borrowed money supported growth, creating future income that helps repay what was borrowed. The world today is interconnected, and debt flows through global markets, linking savers to governments that need financing. What remains clear is that nearly every country owes money because borrowing has become a structural feature of modern economics. Who they owe varies, but most debt is held by domestic institutions, followed by international investors and multilateral agencies. Understanding this allows us to see debt not as a sign of failure, but as a tool that, when managed carefully, supports prosperity and stability.